Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Casmon interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Casmon.
Welcome to Target Market Insights, the multifamily and marketing show. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. Now, if you're enjoying the show, do me one quick favor and leave us that 5-star rating and review. And don't forget to hit the subscribe button so you don't miss an episode. Today, we're going to be talking to my man, Rob Beardsley. Rob Beardsley oversees acquisitions and capital markets for LoneStar Capital, and they've acquired over $100 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting. Rob has written over 50 articles about underwriting, deal structures, and capital markets, and he hosts the Capital Spotlight podcast, which is focused on interviewing institutional investors. Let's welcome to the show, Rob Beardsley.
Thanks for the great intro. Thanks for having me on.
Absolutely, Rob. Listen, it is great to talk to you. We've had a chance to meet a couple times. It's been a little while since we've seen each other, but good to see you. And I've from afar, I've watched you continue to grow your portfolio and do big things. For those listeners who are not familiar with you or your background, why don't you take 1 minute and give us a little bit more context?
Sure. So my business partner and I founded LoneStar Capital about 2.5 years ago. We were both independently seeking acquisitions in select Texas markets, and we just found ourselves competing against each other. So we decided to team up and start chasing after deals together, and that's been working out really well for us. So real estate's always a team sport, so I highly recommend that. So that's LoneStar Capital. We focus on, as you mentioned, garden style, suburban, value add multifamily acquisitions, and my background is I grew up in a real estate family. My parents ran a real estate brokerage firm out in Silicon Valley and really focused on the single family side of things up until really my interests and curiosity led us to start getting involved in larger commercial projects and looking at multifamily. And we just felt that it was such a good fit and a natural evolution for us. So we were able to expand there and grow together. As I went out and started my own multifamily company, they were also able to, utilize their experience to not only advise us, but also get in the business themselves. And they're building their own separate portfolio that we're sharing and building together.
No, that's awesome, man. Especially knowing that your parents, were kind of in the business, but doing it a little bit differently than what you're doing. And you've been able to open up their eyes to better opportunities with commercial multifamily investing and kind of now helping them build that portfolio. And Rob, I know last time we spoke, I believe you were living in New York and getting ready to move. Where are you located right now?
Right now, I'm sitting in California, staying away from the craziness in New York. Haven't been there for a few months. We're recording this in June 2020. So looking forward to getting back there, getting back to normal,
Yeah. So you've kind of went back and forth, right? So you were between California and New York, and then obviously you're doing a lot of investing in Texas. Why Texas for those listening? We hear a lot of great things about Texas, but from your perspective, why is Texas kind of the core market that you focus on? And Texas is huge, by the way. So let's drill down to beyond Texas, but why Texas?
Yeah. So high level, Texas as a state, you've got all the big popular things that people are looking for. It's a no state income tax state. Booming population growth, a lot of new jobs, a lot of headquarter relocations. If you look at Dallas and Houston, they have some of the top numbers for Fortune 500 headquarters. So the demographics are really strong, and the growth there has been really good. And just going back, early this cycle and before, Texas was more of a high cap rate market and not as much of a growth market. And then it evolved into being a growth market, and then steadily cap rates have declined, and now the secret's out and cap rates are low. But generally speaking, compared to your primary markets, there's still a cap rate discount there. So that's high level why Texas is attractive. And then, as you mentioned, drilling in deeper, we specifically like Houston a lot. We've bought into Houston just because we see that there are risks in the Houston market that some institutional investors will just say no to, no matter how good the deal looks. So that creates somewhat of a barrier to entry. And those risks would be hurricanes by the coast, as well as the dependency on the oil markets. And so we have yet to see, what this latest drop in oil prices are going to do to the Houston multifamily market. But it's something that, we're aware of, but it's a risk that we're willing to take for the cap rate premium in Houston compared to other similar size markets. And we're talking about Houston. It's, going to be the third biggest city in the country in just a matter of, maybe a decade or two.
And as a guy who lived in Chicago the last 8 years, that hurts me to hear you say that, but it's true. I mean, Houston is growing at such a pace that it will pass Chicago at some point in the next decade, and it'll be a sad day for many Chicagoans, but there's a lot of great things Houston has going for it. You started to mention two of the drawbacks or two of the concerns that keeps institutional investors on the sidelines. I do know that some of the major lenders, the agency lenders, they also have some pre-underwriting processes that they use when looking at Houston opportunities. You talked about hurricanes, you talked about oil. As an investor, and for most people listening, whether you are passive or you're an active investor, help us understand, those two things, right? Because hurricanes, these natural causes, it's certainly something to look at, whether you're looking at, would be Florida or Texas or Louisiana. So we can look at the natural disaster piece, but most of us learn that you want to look at cities that have a diverse economy that don't have more than 25% of their GDP based on one industry. Talk to me a little bit more about the way you see the hurricanes and oil impacting Houston's economy.
So hurricanes, like you said, natural disaster, can't really do anything about them. There are obviously close to the coast, higher risk locations, and then there are other locations, north that are lower risk. But it is just pocket by pocket. And so insurance is something that you have to be really aware of and really have a good understanding of what your insurance looks like. And so that's something that we really focus on and make sure that we're well insured. And really it becomes, so it's an aversion by some investors, yet it's factored into the price because your cost of insurance is higher, but it's all factored into your cap rate calculation. So at the end of the day, you're still purchasing pretty much the same value of property with the higher insurance baked in. So, I mean, the hurricane stuff is just a pain you have to deal with. If your first floor units flood out, you have to rebuild them, file a claim. On the oil side, in terms of a diverse economy, that's definitely something that all investors should be looking for. And for Houston, it's a big market, and there are some areas that are very dependent, very concentrated, and then there are others that are very diverse and just a completely different city. So that's just something that people might be throwing the baby out with the bathwater, and they say, well, all of Houston is this way, but really, if you know the market and are in the right pockets, you can really benefit from diverse and strong growth.
Yeah, I spent a lot of time in Detroit as well, and that was one of the things when people talk about the automotive industry, right? And I was there from 2007 to 2011, so absolutely the impact of the automotive industry was wide felt. That was obviously an economic recession for the entire country, but we felt it pretty hard in Detroit. So I think for folks who are looking back on recessions and they always pick Houston, Detroit, in Vegas when they talk about industry diversification, because those three cities, I think, have a well-developed reputation for depending on one of those industries. But also, Houston sounds like it's diversifying a lot more and not solely based on oil, but there's other industries that are driving it. How much of that, factors into kind of your underwriting and your approach when you look at the Houston market?
In terms of factoring those things into underwriting, that's one of the harder pieces of underwriting, is actually factoring in more qualitative assumptions and turning them into numbers, right? How do you take, the schools are good in this area, and then factor that into your numbers, right? It's a little trickier. So in terms of factoring those things into our numbers, we try to just stay conservative on our rent growth projections, because by stripping that away from the deal, we're making sure that the deal pencils on its own merit based on the business plan without any upside growth factors that we're assuming from the market. So if the deal can stand alone without the benefit of the market, we know it's a good deal, because at the end of the day, we are investing in good markets. So that's something we do in Houston that is a bit unique compared to, let's say, for example, a Dallas. Dallas, in order to be competitive, you have to factor in some of that rent growth that's occurring in that market. You can't just sit there and say, well, I just want my deal to pencil on its own in Dallas, because you don't buy into Dallas for that reason. You buy into Dallas because of the rent growth, because of all the good things that are happening in that market. So that's a distinction that I think you just have to be aware of, and really understand that you can't just apply a 2%, 3%, 4% rent growth across the board for, any deal or any market that you're in.
Yeah, Rob, let's talk a little bit more about underwriting, because I think that's something that you do extremely well. You wrote a book on it. Let's start with the book. What led you to write this book on underwriting and sharing that with the masses?
Yeah, it's a great question. So the book was an interesting project that I had on my to-do list for a long time, and I just kept pushing it off because it's, writing a book. It's, you think it's a big scary project, so you push it off. But I finally started it, and just the reason why I wanted to write it in the first place was because when I was first starting out, there was no resource like this, and which is really surprising to me, because it's such an integral part of this business. And you would just think that somebody would have already put to paper the step-by-step process and really their full thoughts on this part of the business, but it just hasn't happened. And so I just felt that with all the people, with my wanting it when I first started, and all the people asking me, hey, how do I get started? What did you read? What course did you take? And I just didn't have an answer for them. So that was really my motivation. And the way I wrote it was I really just took my underwriting model, my Excel spreadsheet, and I just looked at every single input and on all the metrics. And I just said, okay. And I explained every single input and what does it mean? What should you put there? What are kind of the general guidelines? So it's a really, straightforward step-by-step book. It's great for a beginner, but it goes deep enough where, even if you're experienced, you're going to have takeaways as far as how to look at certain assumptions and how to, analyze a deal based on different stress tests and metrics.
Yeah. And for anyone listening right now, underwriting is certainly the most complicated part of, this business, in the sense of all the assumptions, all the inputs. You're trying to make projections. It's financial modeling. You've got a financial background. But I think for everyone, it's a science, and it's a bit more of an art than an actual science, because no one is ever right. I mean, you're modeling on, so many line items, and you're making so many assumptions that it's impossible to be perfect. If you are, you should play the lottery. So if you're conservative, you're going to exceed your projections and what you put in that model. If you are optimistic, or if the market shifts on you, or some of those assumptions don't come true, then maybe you miss some of those things. How do you approach it, right? I hear everyone say that they're being conservative. I've never once heard someone say, hey, this is a pretty aggressive model, or we're making pretty aggressive projections here, right? So how do you look at this? And this is really for our passive investors, right? But someone looking at an investment opportunity, how can they ensure that someone really is being conservative, or at least not overly aggressive and optimistic when they're reviewing a deal?
Absolutely. So from the passive side, I think this is kind of a myth that my book is also aiming to bust, which is that passive investors don't have the time, knowledge, or expertise to underwrite deals. And I absolutely think that with a little bit of effort, if you're as a passive investor really want to get into this game, you've got to sharpen up that skill, so that way you can, as deals come your way, you can look at them intelligently. And so I want to create that and make that accessible to even passive investors. But with that being said, if you're just quickly looking at a pro forma and you're not going to underwrite the deal yourself, you just want to look at a few key inputs, and those would be, what does the rent growth assumption look like? What does the exit cap rate look like? And I would say probably an interesting one that is far less talked about and harder to really uncover is the stabilization assumptions, because that's something that people often are aggressive with, is they assume 200 unit property. Yeah, we'll renovate every single unit in just 12 months. Oh, and by the way, we'll stay at 95% occupied during that time, right? It's almost impossible. So I think those three levers are highly sensitive to the deal. So that's another interesting thing as you underwrite deals and get more familiar with inputs versus outputs, is some things you get wrong and it just doesn't really matter. Like if your CapEx budget is $1 million and then, oops, it's actually 1.1 million. it's not going to ruin your deal. An extra 100,000 won't kill your deal. But if you get your rent pro forma, if you thought you were going to have $900 rents, but you only have $850, that could be a dead deal. So it's just finding the important metrics that actually matter and really looking at them closely.
Yeah, so I want to break those down. You said the rent growth, the exit cap rate, and the stabilization assumptions. Rent growth is basically the year over year growth assumptions that you're assuming. And right along with rent growth is probably the expense growth rate as well. So looking at your rent growth and your expense growth and what are those estimations. Exit cap rate is what you're going to sell the property at. So if you're buying it at a 5 cap, what are you projecting the exit cap rate to be? I'm going to come back to that. And then stabilization assumption, which is once you're done with the work, how long is that going to take you? Can you renovate 200 units in 12 months? Really difficult to do, but how long is it going to take you to do it? And then what kind of vacancy, and not just physical vacancy, but what kind of economic vacancy are you going to face while you go through that stabilization period? I want to go to cap rates real quick here. What are your thoughts on entry cap rates? Do you think they matter, or is it something that's just completely blown out of proportion?
Well, it's a really interesting thing because the simplistic view would be to say, well, your entry cap rate doesn't matter because your value add business plan is going to create value, and therefore you can buy at a compressed cap rate, which that's typically today how value add deals work. Is if the market cap rate is, like you said, 5, you may have to pay up and pay a 4.5 cap to get into a value add deal where you have the opportunity to push your operating cap rate up to a 5.5, 6, 6.5. So the key here is it's the answer is this: no, your entry cap rate does not matter, but what matters immensely, potentially more than anything, is what your stabilized yield on cost is, or your stabilized operating cap rate. So basically, as you said, once I've stabilized out my deal, what is my operating cap rate, which would be your NOI at stabilization divided by your cost basis. So what it costs you to achieve that new NOI, which would be your purchase price and your CapEx budget. And if you had negative cash flows to get there, then you have to have interest reserves factored into that. That's all in your cost basis. So sure, I mean, we've bought deals at 2 caps and 4, 5, 6. And so the most important piece is that we get that entry cap rate to a 6, to a 7, to an 8, whatever we need that premium. So that way we're actually getting paid for the risk. Because the problem I see a lot is people get really excited about the value add. They see the before and after pictures. They want to renovate units. But look, if you're going to pay a going in 4 cap to then push rents to get yourself to a 5 or a 5.5 cap, why didn't you just buy a stabilized property to begin with at the 5 cap? You could have avoided all that headache and risk.
Yeah, the risk piece is really the key thing you hit on there. I mean, it's not, if you're going to buy something that's lower, you have to make sure the juice is worth the squeeze, right? I think that's how you squeeze.
Perfect.
Yeah, juice. That's it, right? But to that point, I mean, that's the work you have to factor those in. And I don't see a lot of people doing that. A lot of people do not take a look at that stabilized cap rate and factoring that in. Now, for those who maybe we're going over your heads a little bit, but as we talk about the cap rate, think about the overall valuation or the return that you would expect on your capital if you were investing in stocks or something else. So if you're buying at a 5 cap, you might expect 5% return on your money. And that's one of those things where everyone looks at deals a little bit differently. But as you talk about the underwriting model, you have to factor in the risk there a little bit to make it make sense for you. On your exit cap rate, are you keeping them flat? Are you increasing the exit cap rate? And what market dynamics indicate or direct you on how you adjust your exit cap rate projections?
Yeah. So this is another myth buster that we're going to talk about here with the going in cap rate versus the exit cap rate. Because as we just discussed, you can get into a deal at any cap rate, right? Based on your business plan. So it's not fair to say that you're going to buy at a compressed cap rate and then sell at a spread to that compressed cap rate, right? So and the reason why I bring this up is because the typical advice or guideline, which is pretty good advice, is you should exit at a cap rate that is anywhere from 50 to 100 basis points or 0.5% to 1% over your going in cap rate. But that more applies to stabilized core assets. because once we have value add in play, then your cap rate going in gets distorted. So the way that we had solve for this is we throw out what our going in cap rate is and really focus on the market. And we do that by talking with brokers, by being in the market, by bidding on deals that are both stabilized and value add. So we know what cap rates are really being, what properties are really being traded at. And we take that market cap rate. So let's say today stabilized is 5.5% for this type of property that we're buying. Well, it would be safe to exit for us. We feel about 50 bips over that, which would be a 6% exit cap rate. This is super market dependent and it's deal dependent. And the interesting thing to understand is you have to price your exit cap rate based on what your property will look like when you're selling it. So for example, you could potentially, let's say, buy a building and then wait 10 years. And in 10 years time, that deal will become a value add deal because it'll be 10 years old interiors. It'll need an upgrade. A new investor will be willing to go in there and pay you a compressed cap rate. So if you want to do that, you could, in effect, project a compressed cap rate based on that you're going to sell at a value add. But that's very rare. Most people are fully renovating a property and then projecting to sell a stabilized asset. And that will sell at market cap rates, which will be higher. So it's not fair to say just 50 or 100 basis points across the board. You really need to understand what you're selling, when you're selling, and what the market is today.
Great points, man. That's a very powerful insight because I do know a lot of people who just add 50 basis points, and that's basically think of a 0.1%. So if you're talking about buying it at a 5 cap, 50 basis points means you're going to sell at a 5.5 cap, right? So just that 0.10 is the basis point, and a lot of people will add those 50 basis points. And that's it. Or I've also heard the rule of thumb of 10 basis points for how many years that you're going to hold the asset. And those are good rule of thumbs. But to your point, rule of thumbs are just broad strokes. I think as you get into the nuances, your business plan and all these other factors have to play in. Rob Beardsley, we're talking to right now about underwriting. The last thing was the stabilization assumptions. And this is something that I think a lot of people make mistakes on when it comes to the time frame that it's going to take to renovate a property, understanding how many units you can actually turn in a given month. And then right now, coming out of COVID, where you're in a situation where many investors are slowing down or completely stopping renovations, how would that impact your business plan if you were fully expecting to renovate 100% of the properties in a given time frame, but you end up having to stop or slow down, or maybe you're not able to get those rents to the numbers that you expect? How do you look at that stabilization assumption and factor in all of those variables that can have an impact on the actual timeline?
Well, you said it best. There's just so many factors, and everybody knows that construction, there's always delays, right? And with projects in general, there's always delays. So I think the way that you factor that in is you just be conservative and you assume it'll take you longer than expected, right? The first couple months of takeover is kind of getting an understanding of the operations and figuring some things out, maybe performing immediate repairs, handling those immediate deferred maintenance items, and then diving in and maybe taking care of some of the exterior stuff and then going for the interior. So having a full long timeline, I think, is the more conservative approach. And the reason why we're even talking about this is because depending on how you set up your analysis, it could be extremely sensitive to when you stabilize. Because if I have my rent growth set at 3%, and basically the quicker I stabilize out to my new higher rents, I'll start growing those new higher rents at 3%. So it's just a compounding factor that you have to be really careful about. So, and in terms of COVID right now, we've been elongating those stabilization period times. And that's, I think, a really good way to factor in this current environment, because I think the long-term prospects, and I think most people would agree with me, the long-term prospects of pretty much all of the country is very positive. The economy is growing, population is growing, rents are increasing. Multifamily has a great moat around it for long-term demographics. So I don't want to change my long-term terminal valuation, but the short-term we may have some troubles. So to factor for that, I want to factor in a higher economic loss in the interim, as well as a longer stabilization timeline. Because we have for some projects right now that we're not spending any capital expenditures on. Other projects we have bridge loan on. So the money is there with the lender, and, spend it. You got to get it done as quickly as possible. So there's just, it's definitely case by case, but you just have uncertain things come up.
So as you mentioned right now with COVID, you're factoring in, more economic vacancies and economic loss. And those are everything from bad debt, tenant money that you're just not getting back, loss to lease where you're having to have a little bit of a gap from the current lease to what market rates are, having some concessions. So you may need to give $50 off or $100 off the first month, various things like that to keep occupancy high. You mentioned that you're expecting greater economic vacancy right now. How are you adjusting? Are you doubling it? Are you adding 10%, 20%? How exactly are you adjusting your underwriting to factor in the impact of COVID?
It depends on what the property has experienced thus far already, and it depends on the class of property. So I would say anywhere from, could be that the property was, it is at 5%, but we're just going to assume 7%, which doesn't sound like a lot, but it actually means a lot to your evaluation. Other properties, maybe a C-class asset maybe has some more pain happening, and you might have to assume 12%. So I think giving it anywhere from 2 to 5% increase, should accommodate at least what we're looking at.
Yeah, good points there. And then, as we talk about investors, ultimately our job, your job, my job, when we take these deals and we do all these projections and these underwriting, we are trying to make sure that we can hit the projections that we put in front of investors. What are the questions you get on your underwriting? What are some of the consistent questions you get from investors, the most common questions you get that really, you feel like you're answering frequently from investors?
Interesting. So I think people want to know that your assumptions are defensible. So they want to see you back up your assumptions with evidence. And that evidence typically comes from market data and rent and sales comparables. So, savvy investors, they want to know that this deal can exit, meaning that your projected sales price, because investors know that so much of these returns, depending on the business plan, of course, is dependent upon having that exit there. So you need to be able to back up your exit with sales comps, and knowing the market, having that data to inform you that, yes, a stabilized, renovated asset that is comparable to this one can actually trade for X price I'm projecting in 3, 5, 7 years. Now, if you are going to project 5 to 10 years down the road, that may be more difficult to actually find a sales comp that can directly support your sales price, because you're projecting appreciation over a 5 to 10 year hold period. So there is some nuance there, but definitely on the sales comp side. And then rent comps are huge, because if you're making rent projections, you have to be able to back those up and be informed, and really go at a granular level and understand if you're projecting to hit the rents that are found at another property, that your property actually will look and feel similar to that property, similar location, similar interior finishes, and that the other income, that the ancillary income is on par. If one project is all bills paid, obviously you can't compare it to one that is billing back for utilities. So it's going at that deeper level to really make sure that it's apples to apples.
Makes a ton of sense there. Just appreciate that, Rob. Earlier, you mentioned the bridge loan, and I think that's something else that people are looking at right now is lending terms, lending requirements, lending resources. As you look at kind of where things sit today, what are your thoughts on bridge lending versus, traditional banks or going to agency debt?
Yeah, the debt market is fascinating right now, and it's changing by the day. So the agency market, which is permanent debt, so typically 10-year terms, that market is very healthy, being supported by Fannie Mae and Freddie Mac. The biggest complaint from investors as far as those loans go are the debt service holdbacks. And so if you're not familiar, they're very willing to make loans today at very attractive terms, but they're going to hold back potentially 5 to up to 10% of the loan amount in reserves. And these are, called COVID reserves, essentially, to make sure that if anything goes wrong over the next really 12 months, that money is there and that mortgage will get paid. So, I mean, really, it's a good thing for everybody, but it's causing some investors to have to bring more equity to the table and just disrupt their valuation. And so that's what you have on the permanent side. Capital is available, extremely low interest rates, a little tighter underwriting standards, and those holdbacks. But we're already seeing those holdbacks ease up a bit. So we're very excited to kind of see the health of the market continue to improve. But we never know what's going to happen. On the bridge side, bridge lenders have capital structures internally that cause them to be a little, depending on who they are, be more correlated to the market and have more market risk. So some lenders are all equity and it's on their balance sheet and they're very safe, very comfortable. So, knowing what your bridge lender is actually doing with their money, where it's coming from, is it, are they internally leveraged, or do they have some sort of line of credit that they utilize? Are they selling the loan? Are they securitizing it? And so really understanding how how that's done is really important from the bridge side. And to speak to it today, bridge pricing has really gotten a lot more expensive just because of the uncertainties. And, you only take a bridge loan if you really see true upside in the project. And the lender's your partner because they're also not lending to you based on in-place performance. They're lending to you based on future performance predicated upon your ability to execute. So a bridge lender is a much more of a partner than a stabilized lender. So I think today they're looking for the best borrowers, most believable business plans. And I do not believe that the most believable business plans today are, I'm going to go in there, spend $5,000 on the interiors and raise rents $150. Lenders aren't really buying that. But if you can find a property that's 70% occupied where everybody else is 95, they're going to believe you and you'll get that deal done.
Yeah, you got to find some real value add, right? It's got to be something where there's some sort of mismanagement, something in the market where it's mismanaged. You're talking about vacancy. We actually have, tried to go more direct to seller and find units where all the market data is there, and as is condition, they're under market value by $100, right? Without spending that money. And obviously, if you were to spend it, there may be more upside, but we're not guessing and we're not hoping. The market is telling us right now that there's some mismanagement that's taking place. So I would say if you're going the bridge route or you're looking at some of these value add strategies, you definitely want to make sure that you can truly add value and not just update the finishes of a unit, because there's going to be stress, and stress testing these properties is something that's really important right now. And I think that's necessary if you're going to do a deal in the midst of everything going on. Last question here for you before we move on to our Bullseye Round. I actually have two more questions, but for this one, as we talk about stress testing deals, have you changed any of your metrics in regards to how you stress test an opportunity?
That's a good question. Our stress tests, I think, are unique. So what we do is we look at an exit test, and this is again going back to the bridge loan. This most applies to the bridge loan because, as you said, when there needs to be real value add because you're getting a loan based on your future performance, future value. You need to be able to refi out of that bridge loan into permanent debt, and what we do is we'll stress, and it's a very painful stress test that most deals don't pass. So no, to answer your question, we haven't really changed this test, but the way this test works is we assume that our NOI projection is off by 20%. And then we assume that the economy or the capital markets rather are in a worse place, which means higher cap rates, higher interest rates, lenders willing to loan at lower loan to values. So we look at those two things combined together, that we're off by 20% on our NOI and lenders are lending a lot less. Is our new loan going to be big enough with all those negative conditions to still take out our existing bridge loan? Most often it is a big no, like big time. Mm-hmm. So, and sometimes we have to move forward with a deal because we think, hey, it's close enough. That's very rare to pass. Let's move forward, because it still passes when you individually stress either the performance or the capital markets. Rarely does a deal pass our both test. But yeah, if you're interested in that, go on our website, download the model, play with it yourself, see what passes. But that's our biggest stress test. And I think for the permanent side, when you have a 10-year loan, it's very rare that a deal wouldn't pass that test because you've got 10 years of time for the property's performance, rents to increase, inflation, you're paying down principal via amortization. So all in all, it makes for a much easier time to refinance and pass that exit test.
Got it. Makes a lot of sense there. And I know that was primarily for bridge. You said for kind of an agency loan, it should pass because you have more time in place to do that. I'm looking at our model, I just pulled it up for reference, but we typically look at a variance of around 10 to 15% of a change in NOI, and we stress test the cap rate a full 100 basis points or so in both directions just to see what happens there. How low did you go with yours? You mentioned 20%, which again on NOI for a bridge loan, that makes sense to have it that wide. But if you're getting agency debt day one, how far should you be stress testing the sensitivity analysis there?
Yeah, so great question, because as you said, the the exit test is really aimed at the bridge. So how do you stress an agency deal, right? More of a stabilized yield cash flow deal. And the way that I think is best is to look at your break-even occupancy. So rather than pick a number in terms of, okay, well, 10%, 20%, right? Let the deal tell you what its number is based on all your assumptions and your debt that's in place. So, and what a break-even occupancy number is basically at what occupancy rate do you still have enough cash flow available to pay your debt service? Because that's the most important thing in these deals. We want to make sure that we can continue to stay alive. We might find hard times, but if we can continue to pay our debts, we'll be able to ride the storm, make it to the other side, and good things happen when you own real estate for a long time. So that's the break-even occupancy, and that's what we focus on for more of a cash flow deal with permanent debt. We want to see that break-even occupancy, probably somewhere in the low 80s, but it's just deal specific, right? If you're in a more volatile market, you probably want to be somewhere in the 70s. And you want to be able to see it pass with amortization in place, unless you're taking a full-term interest-only loan. A lot of people get, I don't want to say surprised, but loans often have an interest-only component for the first couple of years, and then that goes away, and then your debt service goes up substantially because now you're paying not only interest, but you're also paying principal. And you want to be able to see your break-even occupancy be strong even when you're paying principal.
No, I love it. Great information there. Rob, last question for you is, I've gotten a lot of enjoyment. We were talking about this before, but I've gotten a lot of enjoyment from your newsletter. As I told you, from a marketer standpoint, I'm not sure 100% who your target audience is, as a lot of the information is very heady. You're such a knowledgeable guy, and you have great perspective when it comes to capital markets and underwriting and things of that nature. But I always get a glimpse of insight anytime I check out your newsletter. Can you just talk a little about, the newsletter, why you write the way you write, and focus so much on kind of advanced strategies and nuances of underwriting in capital markets, and why you drive that for the people?
Yeah, absolutely. So I really appreciate that. The newsletter is something that I just really enjoy doing, and I would write it even if nobody was reading it. But and as you said, it's really over the heads of a lot of people. So if I were writing it to really do my best job of attracting new investors and things like that, it's probably not doing the best. But I write what I'm interested in, and it keeps me going. And I write about things that I'm actually seeing in the market, real time, and epiphanies that I'm having real time. And I, change my mind here and there and put myself out there. And what I love is the people that like yourself, who are actually in the business, they really appreciate it, and they're willing to respond back and agree or disagree, and we can have a good conversation, and we all learn together. So the newsletter has been a great outlet for me, not only to share my information, but also it forces myself to clarify my own thoughts, because everybody knows, when you write something, it really clears things up for you, and you learn it a lot better when you actually put your thoughts onto paper.
Especially if you're sharing it with hundreds, if not thousands of other people, right? You're going to get criticized and pushback. You better make sure you've thought through your perspective. And again, I love the writing that you do. For anyone who would love to join that newsletter and see what we're talking about, what's the best way for them to do that?
Yeah, head over to LoneStarCapGroup.com, and you'll see link at the top or somewhere in the middle to click the link, sign up for the newsletter, and you'll get a welcome email.
All right, we're going to move on to our Bullseye Round. You ready?
Yep.
Give me a failure or an apparent failure that sets you up for later success.
Great. So I think a failure of ours, and why I stressed about the stabilization timeline, is we ourselves bought a pretty hairy deal that was, poorly occupied and had a lot of work and really required a repositioning of the tenant base. And we underestimated that when you buy a deal and you're really trying to raise rents so much and change the demographic so much, you're not going to linearly go from 70% occupied to 90. You're going to go from 70, maybe down to 50, and then get yourself up to 90. So that takes time. And, you definitely want to make sure that you have ample time budgeted for that, as well as ample reserves for that.
All right, give me a digital or mobile resource you recommend for your business.
Well, as we were talking about, definitely recommend going to our website, signing up for the newsletter. You'll get a copy of my Excel spreadsheet, the underwriting model sent to you. Also, just released my new book, The Definitive Guide to Underwriting Multifamily Acquisitions. Check that out on Amazon. Great step-by-step introduction, as well as a deeper dive in some of the things we talked about today.
Well, those are great resources for our audience. What are you using? I mean, what's one app or something that you use to stay connected or quickly look at deals or find deals or communicate with your team?
Yeah. So for the target market insights, we're on justicemap.org. So we look at all the census data available there. We look at the incomes. We're heavily focused on the incomes, and not just the immediate incomes, but also kind of looking at the shading of the graph. We can kind of get a sense of, well, this side of the freeway looks like this, and then this neighborhood over here is a little, higher incomes. And so we love looking at Justice Map for the income data.
Give me a book you've recommended or gifted the most in the last year, outside of your own.
So there's a great book, and I think it's a big sleeper. It's called, what's it called? It's called Investing in Real Estate Private Equity. And it's published under a pseudonym, Sean Cook, I believe. And it's available on Amazon. And it's a really great book for both passive and active investors. It's actually written for the passive investor, but I recommend it all the time, and I've gotten a lot of value.
All right, give me a daily habit that helps you stay focused on your goals.
That's easy. It's the journal right here. Every morning, I wake up and I write what I'm grateful for, and then I write my big goals, and those can be goals anywhere from, in the next 2 months and the next 2 years, 5 years. And then below those goals, I write, what needs to get done today, because what needs to get done today should reflect those bigger goals that I just wrote.
What's one thing you know now that you wish you knew when you were starting out?
Due diligence, do it and do more of it, and do it exhaustively.
What are you curious about right now?
I'm really curious about how the hospitality industry is going to come out of the coronavirus crisis, the pandemic. I'm curious to see how, if these CMBS delinquencies turn into defaults, and then if we're going to see a lot of REO sales by banks for hospitality.
Definitely. I want to go back to the wish you knew question. You said due diligence. It sounds like there was something specific that you've learned. So maybe you can elaborate just a little bit more about the due diligence process. What exactly did you wish you knew when you were starting out there?
So I think some advice you hear a lot is networking and meeting a lot of people and going out there and making partnerships and doing deals and things like that. And I'm all for that. I think you need to go out there, learn from others, meet as many people as possible. So I say network fast, but partner slow. I would say, do your homework, and this is a partner with everything. This is your real estate attorney. This is your property management company. This is your, insurance broker, and the people that are really working with you, on your specific team. So I think that's, obviously due diligence in real estate in terms of, the property, but also due diligence. And this, what came to my mind was due diligence in terms of people, partners, and things like that.
Got it. All right. So I know you kind of are between California, New York, Texas. I'm going to let you pick the location, but give me the best place to grab a bite.
Best place to grab a bite. So definitely New York, and I live downtown in the financial district, and there's a place, Ku Ramen, that has been just my favorite place. We were going there all the time when I was in New York. Dan Hanford and I went there last time he was in New York. Good spot.
Excellent. We'll definitely make sure we check that out the next time we're out in New York and keep that on the list. This has been great information, Rob. I really appreciate you breaking down everything about underwriting, the approach you and your team take when you look at deals. Specifically, you talked about some of the common mistakes or common, mistakes that people make. It comes to rent growth, the exit cap rate, and the stabilization assumptions that are being made, really helping even passive investors to think about how to quickly look at deals, what to look at when they're underwriting deals or reviewing an investment opportunity. And for active investors, just to make sure that they are doing their proper due diligence, that they're being conservative in the way they're projecting these deals and taking care of their investors and making wise decisions. For listeners who want to get in touch with you, can you give us your information one more time of how they can get in touch, as well as the name of your podcast and the book?
Sure. So you can find out more about LoneStar Capital at LoneStarCapGroup.com. There you can find ways to connect with me. But if you want to reach out to me directly, you can email rob@LoneStarCapGroup.com. And as you mentioned, I also recently started a podcast of my own, the Capital Spotlight. There I turn the tables around and interview investors. So hearing from their perspective is also a really great way to learn.
Awesome. Listen, Rob, really great information. Really enjoyed our conversation today. Hope you have a good one, man. You take care, okay?
Thanks for the great interview.